As the week draws to a close, we're opening a window to what next week has in store for the markets. On the monetary front, we note the release of RBA's interest rate decision on Tuesday and BOC's interest rate decision on Wednesday. As for financial releases, we note on Monday Eurozone Sendex index for December and the US factory orders rate for October on Tuesday. We get Japan's Tokyo CPI rates and the US ISM non-manufacturing PMI figure, all for the month of November, and the US JOLT Group openings figure for October on Wednesday. We make a start with Australia's GDP rate for Q3, Germany's industrial orders rate for October, the US ADP national employment figure for November, and Canada's trade balance figure for October. On Thursday, we note Australia's trade balance figure for October, China's trade balance for November, Germany's industrial production rate for October, the UK's Halifax house prices figure for November, followed by the Eurozone's revised GDP rate for Q3, and ending the day is the US weekly initial jobless claims figure. Lastly, on a heavyweight Friday, we note Japan's revised GDP rate for Q3 and the US employment report for the month of November. And finishing off the week is the US University of Michigan preliminary sentiment figure for December. The USD tended to remain relatively unchanged against counterparts for the week. On a monetary level, we note the release of the Fed's beige book. The book states that economic activity has slowed since the previous report, with 6 districts noting slight declines in activity. The report also indicated, when referring to the labor market, that several districts continued to describe labor markets as tight, which could lead to persistent inflationary pressures in the US economy. However, Fed Governor Waller stated that he is increasingly confident that policy is currently well positioned to slow the economy and get inflation back to 2%. The comments made by the governor could be perceived as predominantly dovish, which could send mixed signals to the market participants as the contradicting views appear to be cancelling each other out. On a macroeconomic level, we note the acceleration in the second estimate of the US GDP rate for Q3, which came in better than expected at 5.2%. Traders may now be turning their attention to next week's financial releases from the US, with the US employment data for November, the JOLTS job openings figure for October, and the ISM non-manufacturing PMI figure for November, which may allow the dollar to take the initiative after seemingly having ceded some control over its direction to other currencies this week. The pound is about to end the week higher against the US dollar and the euro, yet relatively unchanged against the JPY. On a monetary level, we note that BOE Governor Bailey reiterated his comments made last week for market participants not to expect inflation to fall quickly, as he stated on Wednesday that the bank would do what it takes in order to reduce inflation to 2%. Hence, should the governor's comments be reiterated by the central bank officials, we may see some support for the pound. On a macroeconomic level, we note a relatively quiet week from the UK in terms of financial releases. Next week appears to be relatively quiet for the UK, with the exception of the UK's Halifax house prices figure for November, which is due to be released on Thursday. As such, we expect the pound's direction to be dictated mostly by fundamentals. JPY is about to end the week stronger against the US dollar and the euro, and relatively unchanged against the pound. On a monetary level, we note the comments made by BOJ board member Nakamura, which tended to sound dovish, implying a continuation of the bank's ultra-loose monetary policy settings. Nevertheless, we tend to stick out to our comments last week that we may see the market's expectations being enhanced for the bank to proceed with its first rate hike being expected in spring next year. On a fundamental level, we continue to highlight the JPY's dual nature as a safe haven and a national currency. And on a macroeconomic level, the deceleration of BOJ's core CPI rates, which were released on Tuesday and came in lower than expected, seemed to cast some doubt over last week's acceleration of Japan's CPI rates for October. Yen traders may be looking towards next week's Tokyo CPI rates due out on Tuesday and Japan's revised GDP rate for Q3 on Friday, which could provide some indication in regards to the direction of the Japanese economy. The common currency is about to end the week in the reds against the US dollar, JPY and the GBP in a sign of general weakness. On a monetary level, we note the comments made by ECB President Lagarde on Monday, implying that inflationary pressures in the Eurozone appear to be easing, and as such further rate hikes by the ECB may not be warranted, which could weigh on the euro. On a macroeconomic level, Eurozone's easing inflationary pressures beyond market expectations for November tended to reinforce the market's expectations for an earlier rate cut by the bank. In addition, France's final GDP rates for Q3 unexpectedly contracted, intensifying recessionary worries for the area as a whole. France came in lower than expected at 0.6%, implying weaker economic activity, which may have aided to the common currency's descent during the week. In the coming week, we note the Eurozone's revised GDP rate for Q3, which we anticipate coming in as expected, if not lower, based on this week's financial releases. In such a scenario, we may see the euro weakening further, whereas a better than expected rate could provide some support for the common currency. AUD is about to end the week high against the US dollar for the third week in a row. On a monetary level, we note that RBA's interest rate decision is due out next week, with AUD/OIS currently implying a 96.27% probability for the bank to remain on hold at 4.35%. In the event that the bank remains on hold, we may see the Aussie weakening should the bank's accompanying statement indicate that the bank is done with hiking. On the other hand, should the accompanying statement indicate that the bank may hike in the future, we may see the Aussie gaining, yet we do not anticipate such a scenario. On a macroeconomic level, traders may be interested in the GDP rate for Q3, which is due out on Wednesday, and the trade balance figure for October, which is due to be released on Thursday. We should also note the release of China's NBS and Caixin manufacturing PMI figures for November, which sent mixed signals, maintaining our worries for the outlook of the Chinese manufacturing sector. We'll turn our focus on China's trade data next week, and a possible slowdown of the import growth rate could weaken AUD. The loonie is about to end for a third week in a row stronger against the US dollar. On a monetary level, we note that the BOC is due to announce its interest rate decision next Wednesday, with CAD/OIS currently implying an 86.32% probability for the bank to remain on hold. In the event that the bank remains on hold, which appears to be the predominant market expectation, we may see the loonie weakening against its counterparts should central bank officials imply that rate cuts may be just around the corner, as the market is widely anticipating a rate cut in March 2024. In case of a hawkish pause, we may see the loonie gaining, as it may contradict the market's expectations. On a fundamental level, oil prices over the past week remained unchanged despite OPEC Plus's announcement for a further extension of the voluntary oil production cuts. In terms of financial releases, this week we note that Canada's GDP rates contracted more than expected, darkening the outlook for Canada's economy. We should note that Canada's employment data has not been released just yet, and should the data indicate that the employment market remains tight, we may see the cut getting some support. In the coming week, we expect the factory, given the high number of high-impact financial releases stemming from the US. We highlight especially the release of the US employment data as the predominant financial release for the week, which could greatly impact the major pairs. As for US equities markets, we note the S&P 500 and NASDAQ 100 remained relatively unchanged since the start of the week, with only Dow Jones 30 making gains as the week nears its end. US stock markets seemed as if they were capitalizing on the gains made in the past month and are preparing for December. Overall, we expect the US equities markets to continue being driven by fundamentals and may focus also on the Fed's intentions. As for gold, we note that the precious metal jumped almost to the 2050 key psychological figure, yet may be due a market correction to low ground next week. The drop of US yields over the week may have also provided some support to the shiny metal, and should they continue in their current direction, we may see a transfer of flows from the interest-bearing US bonds towards the precious metal. We hope that you found this report useful, and from all of us here at IronFX, best wishes, solid trading.
everyone, my name is Emily. In today's video, we are going to talk about the scalping strategy. Scalping is a forex trading strategy that involves opening and closing multiple positions on one or more forex pairs over the course of a day, usually in seconds or minutes. Instead of opening one position at the start of a trend and closing it at the end, scalpers will open and close several positions over the course of a trend. Scalpers usually hold a position for a very short time, getting in and out of a trade within minutes if not seconds. The aim of scalping is to gain just a few pips at a time, looking for multiple small gains rather than fewer larger ones. Scalpers often use CFDs to trade forex pairs that are rising or falling in value. They will open a position to buy if they think the price will rise and open a position to sell if they think the price will fall. The short intervals between trades and the speed of the scalper working with price differentials enables trades to have less exposure to risk overall. In addition, if the trader is very disciplined about cutting their losses on losing trades, their risk is reduced even further. CFDs, which are leveraged products, also enable traders to open a position with a deposit called a margin. This can magnify profits but can just as easily magnify losses because your profit or loss are calculated from the full value of the position. That is why it's so important to have an appropriate risk management strategy in place no matter which scalping techniques you're using. Basically, in order for a scalper to make a significant amount of profit, a larger position size is usually required to make the trade worthwhile. But scalpers must be very careful to avoid high volatility when trading in the forex market and to have a reliable broker that offers minimal recalls. Thank you so much for watching us today, guys. Stay tuned for more educational videos. Bye-bye.
Okay, never mind, let's go ahead and get started. So today's webinar will be on martingale strategy. Okay, I personally don't use this super often. This is more of a way of strategy to cut down on your losses, but we'll just go through them, just go through a couple of strategies and how you can incorporate them into your trading strategy right now. Okay, so as per usual, just a risk warning. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So the material in this webinar is just a personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Okay, redistribution of the material is strictly prohibited. So I'm Melanie and I'll be your speaker for today. So I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here's our agenda for today. We'll just go through a brief intro on what exactly martingale strategy is, and then how it works, the pros and the cons of the strategy, and some trade management if you intend to use martingale. Okay, so let's get started. So the martingale was introduced by French mathematician Paul-Pierre Lévy and became popular in the 18th century. So the martingale was originally a type of betting style based on the premise of doubling down. However, the American mathematician Joseph Leo Dube continued to work on the martingale strategy, but he sought to disprove the possibility of a 100% profitable betting strategy. So the martingale strategy is kind of like a betting strategy and not so much of a technical analysis strategy. Okay, it's more of like betting and gambling or like roulette kind of strategy. So the system's mechanics basically involve an initial bet that is doubled each time the bet becomes a loser. So given enough time, one winning trade will make up for all of the previous losses. So that's why I mentioned a roulette wheel, because if you think about the zero and the double zeros on a roulette wheel, which was then introduced to break the martingale's mechanics by giving the game more possible outcomes. So that made the long run expected profit from using a martingale strategy in roulette negative, and thus discouraged players from using it. Okay, so what exactly is it? When you use a trading strategy that is anticipating a market move, chances are that you might be wrong or right. But most of the time you can't tell, right? So as you know, the markets are irrational. Therefore, there are times when you are right on the money, but there are also times when the markets will prove you wrong. And that's why the martingale strategy is based on the theory of increasing amounts, even if the value is falling in expectation of a future increase. So it's based on the idea of averaging down in order to avoid losses rather than seeking profits. And it's also an extremely risky way of investing or trading, since you are just betting, basically. Okay, let me know in the chat if there are any of you guys who actually regularly use the martingale strategy. I'm just curious to know. Because it is a very popular strategy, although very, very risky. Okay. Let's move on. So here's an example of the martingale strategy. So you can imagine it's basically coin flipping. So suppose you engage in a game of either heads or tails with a starting wager of $1. So there's an equal probability of it being heads or tails. So if you lose, you would double the wager on the next bet in order to essentially cover your losses. As long as you stick with the same call, you would eventually, given an infinite amount of money, you would eventually see the coin land in your favor. And it will also recoup all of your losses plus an additional dollar. So the way of visualizing this is to basically understand the basics or the underlying theory of the martingale strategy. So if we're talking about the example that I just gave about coin flipping, if we look at the first column, which is the lose column, let's say you are betting one coin or $1, right? And then you lose. So essentially the strategy encourages you to double the amount that you are betting. So in this case, it will be $2. And then if you happen to lose again, then you double it again and you get $4 and you're betting $4. And then if you lose again and you bet double the amount, that's how much you are winning. If of course it lands in your favor. So what we mean by recoup your losses plus an additional dollar, you can see here we are losing 1, 2, 3, 4, 5, 6, 7. We are losing $7 in our initial rounds. But since we doubled each round, our ultimate winning stage or our profit is essentially an additional dollar here. Okay, so the strategy is basically is based on the premise that only one trade is needed to turn your account around. Okay, so if we're taking a look at a chart and we apply the same concept to our trading charts, right? You can see here, if we ignore all of this, we start off at this first buy one lot area. Okay, so we buy one lot and then we see price continue to drop. Okay, so we can see that we're obviously going to make losses since price is moving in the opposite direction, right? So price is dropping, I'm losing money, but instead of cutting my losses or getting out of the trade, right, I decide to buy 2 lots instead. So I'm doubling it using the same concept of the coin flipping strategy in my previous example. I'm doubling my lots here. I buy 2 lots. And I can see even though price did increase by a little bit, it reversed and it ultimately continued to drop. So I'm actually losing 3 lots now. Okay, so I'm losing some more money. And then instead of getting out the trade again, I'm buying 4 lots. So you can see it's a very risky trading strategy, and yeah, I probably would not recommend it unless you're trying to cut your losses. But yeah, this is basically how it works. So we buy 4 lots, right? And you can see price did increase a little bit, okay? And then it dropped again. So now that it dropped, going by the same martingale strategy, I will double it again, buy 8 lots, continues to drop. So I've essentially lost all of these lots, okay? Which is a huge loss if you think about it. And then once I reach the bottom here, I decide, okay, I'm gonna double it again. I'm gonna continue with my martingale strategy, right? So I buy another 16 lots here. But instead of continuing to drop, my luck changes and the chart decides to reverse off and it's heading upwards again. So now that it's heading upwards, I can imagine that now that I have 16 lots, I'm making back all of these losses. Okay, and I can see that it's really increasing, it drops, and it continues to increase from this support level here at the 0.98803 level. So, okay, so it bounced off this support level and it continues to rise up, enabling me to make back all of my losses as well as a little bit of profit. So that's essentially the theory behind martingale. Okay. Let me know if you guys have any questions. Okay, so it's a popular strategy, as I mentioned earlier. And one of the reasons why it's really popular in currency market, so like Forex, is that currencies, unlike stocks, rarely drop to zero. So although companies can easily go bankrupt, most countries would only do so by choice. So there will be times when a currency falls in value, but even in cases of a sharp decline, the currency's value rarely reaches zero. So the FX market, another advantage that it offers is that it makes it more attractive for traders who have the capital to follow the martingale strategy. So the ability to earn interest allows traders to offset a portion of their losses with interest income. So that means that an astute martingale trader may want to use the strategy on currency pairs in the direction of positive carry. So in other words, they would borrow using a low interest rate currency and buy a currency with a higher interest rate. Okay, but as we mentioned earlier, for this method to work, the underlying assumption is that you have and infinite capital, which in most cases is unrealistic. Okay, because the money in your pocket is always going to be less than the chance that the next operation is a loser or the price goes against you. Okay, so let's take a look at another example here. So you can see price is moving upwards at the start, right? So at this resistance, I decide to buy one lot because I expect the price is going to continue in this increasing trend. But instead of continuing, it reverses off of my resistance at 1.12417. So it reverses and then it hits down. At this swing low, I decide to buy 2 lots. Okay, so it goes up and I do make back some of my losses. However, it reverses back down again. And it reverses up, and at this swing high, I buy another lot. Okay, so essentially for every lot that I lose, I'm doubling it, okay, to earn back what I lost earlier, and then restart that. Okay, so over here, once I've made back my losses, here I'm buying once again, buy one lot, but instead of increasing, it drops again. So now it drops again, I'm buying 2 lots, I'm doubling it, it increases just as I expected, I make back my losses, and then it drops again. So it's the same kind of concept. Lastly, price increases, I buy one lot, it drops, and I buy 2 lots. And you can see it really increases, really moves upwards. So I really am earning back my losses as well as a little bit of profit. Okay, but of course, you wouldn't know whether price is going to continue to go up or it's going to reverse, which is why it's an entirely based on luck and bets. Okay, the reverse martingale, okay, is basically looking at 0.5 lots. So instead of doubling it, in this case, we are dividing by 2, okay, or looking at a factor of 2. So here at my first swing low, we have buy one lot. So I expect it to go up, I make that profit, and then I buy another 0.5 lot. Okay, because I didn't make any losses. Price moved upwards just as I expected. So I buy 0.5 lot and moves upwards just as I expected, and I buy another 0.125 and it rises, and buy another 0.06 and it rises. Okay, so this is the anti-martingale strategy, which I personally don't use, but you can let me know in the chat if you use this and you think that it's useful. Okay, so from this trade, we've made 750 pips just from 3 trades. Okay, so we only needed 1 trade to break even. Okay, so here are some limitations of using the martingale strategy. So when you use a trading system that is anticipating a market move, chances are that you might be wrong or right. So there's equal probability. But you cannot be right all the time because you know that markets are irrational. So therefore, there are times when you are right on the money, but there are times that markets will prove you wrong. So there are a couple of important considerations for you to take note of. Okay, firstly, the amount invested can reach huge proportions after a few transactions, since we are constantly increasing our lot size or constantly doubling our lot size. So if the trader runs out of funds and exits the trade, the losses faced can be disastrous. Yeah, you've used it before. Almost had a heart attack looking at equity. Yeah, so it's purely a betting game. But it's quite, I guess for scalpers, they tend to prefer to use this in order to curb their losses. So yeah, to each their own, but it's just keep in mind that it's very risky. So the risk to reward ratio is also not reasonable. High amounts are spent with every loss until a win, again because you are doubling your lot size. and the final profit is only equal to the initial bet size. So what this means is that your initial bet size, which is typically one lot, your final profit, since you have made so many losses before your final profit, your final profit will not be a significant amount. Okay, so some important considerations. The martingale strategy assumes that you have an infinite amount of capital. So we mentioned this earlier. And in reality, and it also assumes that markets will eventually reverse and it will be in your favor. But in reality, both of these assumptions are incorrect. So the forex markets can trend for extended periods, resulting in a series of losing trades that can quickly wipe out your trading account. So the strategy can lead to large drawdowns and may not be suitable for traders with limited capital or those who cannot withstand substantial losses. So if you are thinking of using the martingale strategy, proper risk management and stop loss orders are critical when using the strategy in order to prevent catastrophic losses. Okay, so I'm just gonna quickly go through a couple of risk management or trade management strategies that you can implement if you are considering using the martingale strategy, just to prevent losses. Yeah, but actually these trading strategies or trade management strategies are useful even if you're not using the martingale strategy, even if you are just using technical analysis. It's always important to make sure that you pay attention to your trade management. Okay, so if you were here for our trade management series, some of these slides will be familiar. Okay, but I'll just quickly go through them. So firstly, we have trade management with confluence. So this is super important for any kind of trade. Okay, even if you're not using martingale strategy, this is still important. So stop loss is typically placed beyond a confluence area. Okay, so if you're wondering what exactly is a confluence area, it's basically where there are different support and resistance levels that match up with Fibonacci or your moving average, all of these signals. If they tell you that one specific area is important after using several different indicators, that is what we call a confluence area. Because price has tested that level many times before, so it's likely to test that level again since price is attracted to strong areas of confluence. Okay? So for stop loss, we typically would recommend you to place it beyond a key confluence area because price is attracted to these areas. And if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So this is one of the reasons why most people wonder why they got stopped out right when the market starts to reverse. Okay, so if we take a look at the chart that I've included below, let's take a look at our stop loss first. Okay, so we're going in this example for a buy entry. So we're expecting prices to move upwards, right? But in this case, price is moving downwards. So we've placed our stop loss below or beyond this Fibonacci confluence area. And then now let's take a look at our take profit. So your take profit, we would recommend you to place it before a key confluence area because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it actually reverses back to your entry, or even worse, your stop loss. So that's one of the reasons why people complain that there is market manipulation because they miss that take profit by 1 or 2 pips. Okay, so let's take a look at the diagram again. In this case, my take profit is placed above since I'm going in for a buy. Okay, and instead of placing it beyond it, which is like what we did for our stop loss. I'm placing it before it in order to make sure that I catch the price before it reverses off of the confluence area. Okay? Okay, here is another example. In this case, we are going in for a sell, which is why our take profit is below, or rather it is at our support level. Okay, so this is actually support area, not resistance. Yeah, so we're going in for a sell, and instead of placing my take profit beyond it, like what we saw in our previous example for stop loss, now I'm placing it before it. As for our stop loss, I'm placing it beyond my major resistance area or confluence area in order to make sure that I don't get stopped out before price reverses. Okay. Okay, let me know if there are any questions so far. Okay, but if not, let's continue. So let's take a look at another example. So in this example, we expect price to bounce off of our entry at 87.625. So this blue line here. And this line is a pullback resistance. So what we mean by pullback is when we have a swing low and price bounces off that swing low and swing low support, it bounces off it and it reverses and breaks out of the support. That's what we call a pullback resistance because we are expecting price to pull back to that same level. Okay, so this pullback level is in line with a 78.6% Fibonacci retracement. So you can see my starting point here and ending point here. Okay, so it's in line. So that's what we call a confluence area. Okay, so we're expecting price to continue to drop from our entry. Okay. So you can see price has hit our entry and has reversed nicely off of it and it's heading towards our take profit. Now, if we take a look here, I have a Fibonacci projection. So this is wrong. It should be 78.6% Fibonacci projection. Okay, so my starting point is here, middle point and ending point. So for Fibonacci projection, we're looking for this flash shape here, like a lightning bolt kind of shape. Okay, and my 78.6% lines up with my take profit. Okay, and the reason why we placed our take profit at this swing low is also because, of course, this is a significant level since it's a swing low support. Okay, so instead, you can see here, instead of placing it before, I mean, I did place it slightly before, but I mean, instead of placing it beyond it, place it slightly before, and I can see price just touched our take profit before reversing off of it. Okay, so I was able to catch that price, or you can see it's very, very close. So I was able to catch it before it reversed off. Okay, and luckily I did because after that it reversed off of the take profit and rose steadily to our stop loss. So can you imagine if I placed my take profit below instead of above our confluence area, I would have missed it and I would have been stopped out. Okay, so similarly, if we're taking a look at let me go back. Okay, if I'm applying it to maybe over here, our martingale strategy. Okay, my entry point would probably be here, right? If I'm going in for buy. Okay, and then my stop loss would probably be somewhere up here since my previous price has reached this resistance level. So my stop loss would probably be beyond it in order to make sure that I don't get stopped out in case of price breaks out. Okay. Oh, actually, if I'm going in for a buy, I will place my take profit on top. Okay, and my stop losses will be below. Okay, since obviously I'm going in for a buy. But in this case, because we are using the martingale strategy, you don't want to be stopped out. Like no matter what, you don't want to be stopped out. Okay, so if we take a look here, okay, this is kind of a bad example, but we would try and find an area where we can expect price, okay, maybe over here. I don't know if you guys can see my mouse, but you can see price kind of has this overlap support level here because we have a kind of a swing high here and a swing low here, okay, that line up in the same level. So I probably want to place my stop loss beyond this area, so just under here, okay, just to make sure that in case price reverses off, I wouldn't get stopped out, or I would get stopped out, but with minimal losses. Okay, but luckily in this case, we see price continue to move upwards, and we earn back our losses from our first entry. Okay, so that's what I mean by trade management is super important if you're using the martingale strategy. In this case here, let's take a look at the buy one lot. Okay, your take profit will probably be maybe here at this swing high here, and then my stop loss would probably be just under here. Okay, so if I'm going in for a buy here, okay, I can see price didn't increase at all. In fact, it reversed and it hit it down, but we didn't get stopped out because our stop loss is beyond this swing low support level. So we place it below it or beyond it, then we're not stopped out, and then we earn back our losses again. Okay, I hope I explained that clearly. But yeah, I just wanted to give you guys an example of how you can use this for martingale. Okay, here's another example with a couple more Fibonacci levels. Okay, so our second example looks at the Kiwi and Japanese yen. So price looks like it's dropping, right? We have this descending trend line, but price recently broke out of it. So that's a sign that price is, or rather a reversal in trend. That's a sign of a reversal in trend. So our entry is placed here at this swing low, or rather this overlap resistance. Okay, because it basically means that there are bulls and bears that are respecting that area. So we have swing lows and swing highs that line up in the same level. Okay, so we're going in for a buy entry. Okay, going in for a buy entry towards this take profit. So how do we know where to put our take profit in this case? Because we make use of our Fibonacci levels. Okay, here you can see we actually have three different types of Fibonacci. So we have the minus 27.2% Fibonacci expansion, the 127.2% Fibonacci extension, as well as the 78.6% Fibonacci projection. Okay, so we have all of those levels that line up in this area here, and that's why we decide to put our take profit here. Okay, so here's what happened. Since we placed our take profit beyond the confluence area, okay, above it or beyond it, instead of before it, as we mentioned earlier, okay, instead we placed it beyond it, and so price reversed off of our confluence area, and we missed our take profit by very few pips. So instead, what we should have done is to put our take profit below, just below it, and price hits our take profit nicely before reversing back down to our entry. Okay. Next, let's take a look at break even. So this is kind of the entire concept of martingale strategy. It's basically to allow you to reduce your losses and just break even. Maybe not even take a look at the profit, since profits are about the same value as your initial amount. Okay, so break even is basically a level where you are in profit and recognize that there is a risk of reversal, which means that price is likely to hit back to your entry. So the level is basically you saying, if I'm right, then price should go all the way to my target. But if it goes back to my entry, then I'm wrong and I should get out ASAP. Okay, so firstly, we have our entry. In this example, we have our entry at this double swing high resistance. Okay, and then price kind of fluctuates in between, and it hits this level. It hits this level here, and it reverses and it continues upwards. Okay, so it continues upwards towards our take profit. So our take profit is at this green area here. So it's continuing, but it actually reverses. So now that I see it reverse, I quickly go in and at my break even level here. Okay, this is where my break even is at, this swing high resistance, and my break even is triggered at this level. Okay, so I see price continue upwards, reverse down, and hit my break even. And then what I'm going to do is I'm going to shift my stop loss line from below here to over at our entry. Okay, so we do this in order to break even and protect our position. So if price continues to rise, that's great. We'll probably hit our take profit. But if it doesn't, which you can see in this case it didn't, we do want to be protected. Okay, so we got out of this losing trade at break even. Now, if we take a look at the next example, which is idea invalidation, it's kind of the same concept, but in this case, we are placing the idea invalidation level before the stop loss. Okay, but same thing, it's basically the level where you admit that you are wrong and you want to get out of the trade. So when this level is reached, your take profit is moved to your entry, giving you a small chance to get out at break even. So in the previous example for break even, we moved our stop loss levels. For idea invalidation now we are getting out and just taking a bit of profit. Okay, let's take a look at this example. Our entry is here at this double swing high again. So I'm going in for a sell entry now in this case. Okay. So in this case, I am looking for a sell entry. So I'm moving downwards. Okay, I see price dropping towards our take profit, but instead of continuing, it reverses and it hits back towards our entry. So I can see my entry here. It actually breaks out of my entry and it hits upwards. Okay, it hits upwards and it triggers my idea invalidation level. Thankfully, instead of continuing to our stop loss, it reversed off of the idea invalidation. And then we admit we're wrong, and then we get out of the trade by moving our take profit to the entry. Okay. So if you're wondering, why is it that we can expect price to reverse off of this level? Like, why won't price continue to? It definitely can, but the reason why we have this idea validation level is because, like we mentioned earlier, these significant levels of confluence, like swing high resistances in this case, or like Fibonacci confluence areas is because price is likely to reverse off of those levels. So that's why we can take the opportunity, see it reverse, and maybe see if it continues our take profit. In this case, it didn't. So that's why we would place our take profit here. Okay? Okay. Okay, now that we've been taking a look at a lot of lot sizes because we're talking about the martingale strategy. So maybe let's touch a bit on leverage. Okay, so leverage in trading basically refers to the use of borrowed funds or margin to increase the potential return on investment. So in other words, it allows traders to control a large amount of assets with a relatively small amount of capital. Okay, so in the case of Forex, money is usually borrowed from a broker. Forex trading does offer high leverage in the sense that for an initial margin requirement, a trader can build up and control a huge amount of money. Okay, so that's one of the reasons also why martingale strategy is pretty popular for Forex since it offers a high leverage. Okay, but another danger, of course, is that if you lose your initial margin requirement or your initial margin, you would basically empty out your capital. Okay, so here's an example. So let's say you want to buy 1,000 shares of a stock that is trading at $10 per share. Okay, in this case, we are talking about stocks. In this example, we're using stocks, but similar idea can be used for the different currencies that you're using. Okay, so but you only have $5,000 in your trading account. So you use a leverage ratio of 2 to 1, and then you borrow an additional $5,000 from your broker, giving you total of $10,000 to buy the shares. So this means that if the stock increases by 10%, your return will be $1,000 or 20% of your original investment. So while leverage can amplify your profits, it also magnifies losses. So it's important to note that the use of leverage involves borrowing money and incurring interest charges and fees. And we kind of talked about this when we were introducing martingale strategy. Okay, so therefore it's crucial to understand the risk that's involved if you decide to use the martingale strategy or if you decide to use leverage. Okay, so again, a couple of examples. Capital of 10,000, just how we calculate the leverage. If it's 1 to 20, it would be 20 times 10,000, giving you a position of 200,000. 1 to 100 will give you $1 million, and 1 to 500 would then give you $5 million. Okay, and here's how we calculate profit. So, depending on your risk appetite, if we're looking at high risk, your lot size would maybe be 5 lots. So your total value of transaction would be 500,000. Okay, 10,000 times 500, 500,000, and then if you make a 100 pip profit, it'll be plus $5,000. So you gain 50% of your trading capital because you can see your initial capital is 10,000. So now I have made a 100 pip profit, giving me an additional $5,000. Okay, if we're talking about low risk, I'm just using one lot. 10,000, my total value of transaction, my initial capital is 10,000 with a lot size of 1. Total value of transaction is 100,000. So if with a 100 pip profit, I would be making $1,000, which is 10% of my initial capital. Okay. So we want to emphasize that it is a double-edged sword because obviously if you can make 50%, you can also lose 50%. Okay, so yeah, just be careful of that. And let's touch a bit on margin before we end off. So margin in trading refers to the amount of money that a trader needs to set aside in their trading account in order to open and maintain a leveraged position. So it's essentially a deposit or collateral that the trader is required to put up in order to cover any potential losses. So this is just how to calculate margin if you are curious. Most of the time, your whatever trading platform that you're using, it will calculate it for you. But yeah, a margin-based leverage basically equals to the total value of transaction divided by the margin that's required. Okay? So let's say, for example, if you're required to deposit 1% of the total transaction value as margin, and you intend to trade maybe one standard lot of $1 that would be equivalent to 100,000 USD, but the margin required is only $1,000. So your margin-based leverage will be 100 to 1. Okay, so for a margin-based margin requirement of 0.25, you can see here your margin-based leverage would be 400 to 1, and it's using the same formula. Okay, leverage in the forex markets tends to be significantly larger than the 2 to 1 leverage that's provided on equities, and even the 15 to 1 leverage provided in the futures market. So although 100 to 1 leverage may seem extremely risky, the risk is significantly less when you consider that currency prices usually change by less than 1% during intraday trading. Again, this is why martingale strategy is really popular amongst scalpers who are trading forex. Okay, so traders should choose the level of leverage that makes them the most comfortable. If you're conservative and you don't like taking many risks, or you're still learning how to trade forex, a low level of leverage would maybe be better, like 5:1 or 10:1 might be more appropriate. So for more seasoned or risk-tolerant traders, then you might be comfortable with 50 to 1 or 100 to 1. Okay, so there are different types of traders as well. So martingale would probably suit more scalpers or intraday traders as compared to swing traders and people who prefer to just place your trades and then go about your day. Okay, this is just some examples from MT4. So the margin denotes the amount that's held by for the trades that are already open. So free margin, here I'm looking at this area, this gray area. Free margin denotes the amount of funds that is available to open new trades. Okay, so when equity sold balance plus minus open profit or loss, that's how you calculate your equity here. But you can see it's normally already calculated for you. So if that falls below 90% of the margin that's required for maintaining your positions, then you will probably get a margin call. Okay, so in that situation, you would then be required to deposit more cash to sustain your positions, or you might be forced to close your account. Okay, stop out. So margin denotes the amount held for the trades that are already open. Free margin falls below 50% of the margin required for maintaining your positions. Positions will be automatically closed in order for the largest losing position to be the smallest. Okay, and let me know if you guys have any questions, but that brings us to the end of our webinar. And yeah, let me know if you guys have any specific questions about martingale or anything like that. Okay, if there are no questions, yeah, you guys can leave. Thank you guys so much for joining me today. I hope you guys found this session helpful, and I'll see you guys next week. Bye, everyone. Have a great rest of your week.